Okay, welcome everyone. I want to welcome you to our August 16th, 2023 update for the markets. It's been quite an interesting 8 months with markets going all over the place, as we would have expected, although we did expect it to go down a lot more and a lot harder. We'll go over that in some detail. Beforehand, of course, the usual disclaimer. Obviously, if you decide to do anything or not do anything based on information you hear here, please, double check it, do your own due diligence, ask your professional, etc. So we also, as you may know, have a website and a Twitter account at the moment, Telegram, and a YouTube channel which has some interesting information on it as well. Please feel free to periodically take a look at it. Housekeeping. What's most important is we'll be recording this and posting it in a few days on our YouTube channel. That means you can review it and you don't have to make notes, although you're always welcome to take notes, but this way you can listen to what I'm saying and then review it as you wish. And of course, this is open and you can invite colleagues and friends to watch. The most interesting part of any presentation is usually the questions and answers. We have a chat box and you can just put what you want and only put what you want in terms of questions there. And at the end, we'll try to take them. If you want to do it verbally, we'll play with that as well and take a few verbal questions. But if as you're going along you have a question, feel free to put it in there. We'll answer as many as we can. So what are the two main questions you may want to know? The first is now a good time to invest in the stock market? Obviously, a question one can ask every day, but certainly in August, it doesn't look like it's going in the direction of bulls. The second question, that's extremely important, when is a good time to invest in gold and silver, which are two of our favorite sectors? Is now a good time? Is the bottom in? How high are we going and when are we going? We're trying to give you some clues on these two critical questions. Our basic thesis was that the bear market was not over. Now, depending on how you want to define this, clearly markets went up over 20% from their October lows. And we had events with the financial crisis that should have brought the market way down. So looking at it from a pre-2023 view, we felt there'd be some very major crisis. We didn't anticipate, although perhaps we should have, that markets, or rather the government, would break the law, and which they did by guaranteeing everybody, and that was one thing that held it up. But leaving that aside, remember, it's only 7, 8, or 10 stocks that were up. If you look up till May 25th, the market was neutral. Actually, it was slightly down. We had just everything in 7 stocks. So if you leave those 7 or 8 stocks out, the market is not in very good shape at all. So, our view is that the markets keep going back and forth between inflation and recession. Some days they're worried about recession, some days they're worried about inflation, and they alternate with what I consider a fantasy of a soft landing, which means everything's going to be perfect. This is what I think of the view of recession and inflation. It's a unicorn, and not a unicorn with billions of dollars, but a unicorn fantasy. For many people, they're already in recession. For many things, there is inflation. Every time I go, now, there are things obviously that are declining in price, but if you take most food items, most energy items, there's certainly inflation, and it's well above the 2% of the government target. What is the result of this? Effectively, more and more people will be squeezed. This is a little early because there was a lot of COVID money. There's a lot with the Inflation Reduction Act, but more and more consumers are being squeezed. When we see results that show that consumers spending more, they're actually buying less items because they're not inflation adjusted. Now, the big thing was we were of the view that to sell in May and go away. Now, we're not talking about trading, because every day you can trade the market up and down. We believe, which is roughly 41.69, that we're going to see a retest of that, probably of 4,000, and potentially even the October lows. We still hold on to that over the next 2 to 3 months. Clearly, if between now and October the markets are over 41.69, that is to say 8 stocks, then that was an incorrect trade. At the moment, we're still holding to it. Of course, the market didn't hit those numbers yet, but we're still maintaining it. Why? Because in our view, the market's wrong. Supposedly, people think they're wrong. The market constantly was buying, apparently under the fantasy that the Fed would potentially lower rates in 2023, which they're clearly not going to do. They probably will in 2024, which will help the president in office. And according to Goldman Sachs, that's about second quarter. I think that's very realistic. There's a very good chance, over 50%, that the Fed will raise 25% either in one of the next 2 times, especially because this gives them room to lower it later and because inflation is much higher than they expect. Regardless, recession is not priced into the equity markets, and in my view, there is recession. Depending on how you want to define it. We already had it with 2 negative GDP quarters, and then they changed the definition. Market price action over time does not reflect economic reality because inflation is underreported and the GDP is overstated. So think about that for a moment. But if everybody thinks it's the case, that's the way you have to play the game, even if it's not true. The American consumer is getting increasingly squeezed. There's still money left over from COVID. There's still money coming in with Inflation Reduction Act, which is I don't quite see how it reduces inflation. Neither does anybody else, although it's a nice name. So a recession that's a little bit stronger than what we see is in the cards. There's almost nothing that's going to change that. So what is our strategy? And what has been our strategy, and why is it generally successful? First of all, we go to extreme positions to buy or sell. When obviously at support, if we have second or third level support, it's more likely either to make money or to lose less. Likewise, if we're selling at second or third resistance, it's more likely to be profitable or not lose money. So we've had 2 strategies. One is to sell markets on rallies, and most of these didn't last much more than a day, but we'll talk about that. But we did extremely successful on buying commodities, gold, silver, oil, on weakness. Constantly brought home the bacon at all the technical points that you would expect to. We're still on the selling markets on rallies, and we're still keeping this. Is there compelling valuation in the market? No. They're scarce as hen's teeth. So what are we looking for? Our 52-week lows, and we're looking even still to the October 22 lows, i.e. we have a lot of cash available. A lot of people put it to work. In the July close, that was not so much ourselves. Our trading strategy is very similar. We like to buy or sell at P2 or P3 positions, but we take profits 50% losses. Again, if you have, somehow I'm hearing a little bit of an echo here, please put yourself on mute. I'll have to come back to that in a second. I don't know where the mute's coming from. So take profits frequently, which is what we've done. Very often that's all we had, but it's better than losing money, and know where the exits are. By and large, we're still short. We have trading strategies like there's no tomorrow, or we're just ignoring everything, and we certainly know where the exits are. What is your risk tolerance? Low, modest, average, high, or cowboy? If you're not a cowboy, you should not be fully invested in this market, without question. Think about that. It's a very important point. Our last trade, and we did it several times, was a short at 45.70 SPU 2600, and NASDAQ 141.75. That's doing quite well, and we're still holding that. This reminds me a little bit in 2000, 2001, when we were shorting the markets. Remember when the NASDAQ was 4,000, then went to 5,000. We did some shorts at 4,000, but took the 5,000 and wrote it down. Our play at that time, I remember, was with, which company was that? A senior moment. Give me a second. One moment. I've got a little bit of a background here. I've got to get rid of background noise. Excuse me 1 moment, please. It is and these are muted. Okay, I don't know where the background is, but there's from somewhere. Okay, let me get back. So basically, we're holding those, and we think we can hold it. Oh, it was Yahoo. Yahoo at the time, we shorted at 125, exited at 135. We shorted again at 175, exited at 185, and we shorted at 200 and wrote it well below 30. And that's sort of how we've been playing the market here. We've also been looking at what you own. Remember, it's not a question, and we're leaving taxes aside for the moment. It's not a question of whether you own something that goes up or down. It's whether it's the best use of the money. And I remember at the Cornell Club, where I am at the moment, one of the people who was a very successful, aggressive investor, had a lot of the video. Of course, as you know, people have been recommending again. I think it's a little silly, and building in futures, although we do like AI as a theme. And we suggested instead to sell it, to buy MAG, and to buy the new metals. And by and large, this is a hold that we're going to review December 23rd and in December 24th. We think it will definitely outperform simply holding the video. But you may not want to do such sophisticated hedges all the time, and we're going to give you some alternatives. What are the considerations? The first is the Fed pause. When are they going to stop? When are they going to reduce? They may or may not in the next 2 times pause, but they certainly will in 2024, and they probably will start reducing sometime before the election. The Ukraine war, totally unknown. If there's a ceasefire, there'll be a deserved rally. At the moment, it's horrible on many, many levels. And the other new thing is the BRICS, dollar alternatives. August 22nd to 24th, whether they'll make some announcements. We know the dollar, much global trade is being de-dollarized, probably between 10 and 30%. I don't think we'll even get to 50. But a surprise announcement could be very strong. It could be very positive for gold and very negative for many other things. We have stagflation, shrinkflation. We've talked about this before. And it's here. It's very obvious to anybody who lives, eats, and breathes. But what is the danger? Many people are highly leveraged, have a lot of risk and fraud, especially in the Bitcoin area. I think you have to watch that a bit, but distressed investing is just beginning. There's a lot more to go. So I think stock picking is important. I think income and dividends will become increasingly important, and high volatility, I don't think it started yet. In fact, let's take a quick look at where is the VIX at the moment. VIX did it. Please. The VIX is at 16. Certainly it's going to go back into the 20s, almost definitely. We talked about these trades before, so the idea of Max Silver, and you're going to hear from Max Silver I asked them to do a 6-minute presentation for 4 reasons why I think if you only own 1 or 2 gold and silver stocks, this should be one of them. The oil trades and have been obviously making money consistently. We'll talk about that later. And also, whether you're trading the metals company or not, I asked for a short presentation there. We'll give a little introduction. So those did well. The most important thing is to benefit from inflation. What's amazing is that gold is a classic inflation hedge, and yet every computer, once there's inflation, sells gold. Now, that at some point that's going to shift, but anybody who's a gold investor traditionally is buying gold for this reason. So there are many disconnects. But the idea is not to worry about inflation, but to make money from it. And the 2 classic hedges are, of course, the stock market at the right time, at the right place, and also real estate at the right time and the right place. So from where we are, and certainly from 4,600, 4,500, how much upside is there versus the risk? And clearly, the longer we're here, the closer we get to October, the more risk. So there are lots of ups and down reasons. For the markets, not important, because that is what people do with their money. And the issue is really inflation. Is inflation really under 5%? I don't think so. For example, for those of you that live in New York City, the New York pedicabs in Central Park, which raised themselves from $5 a minute to $7.99 a minute, have just raised themselves to $8.99 a minute. That's 15%. The postage stamps, the U.S. government has gone up. Many other things have gone up, and they're going up over 5%. So I don't buy this 3% inflation, much higher, but not being reported. But it may not be much higher than 5% at the moment, because there are things going down, such as electric cars. We've talked about markets. It's not your grandfather's market. You have to watch out for computer investing. You have to watch out for meme investing. And you have to... Excuse me. People, if you can mute yourself, hold on 1 second. Why do we have them muted? Okay, let me mute everybody. I don't know what happened there, but somehow we lost a few people there. Okay, so meme investing, we've talked about this, but the faster trading times, everything happens very fast. So you've either got to be trading very actively or say, forget about it and do what we think, invest for 2024 and don't worry about it. Technically, the markets are starting to be favorable to bears. They were certainly not favorable to bears beforehand from a technical viewpoint, only from a fundamental viewpoint. Bitcoin, everyone knows our views there. Gold. What is the value of gold? Right now, I believe it's undervalued. It's been fighting the 1925 and 1915 support levels. I think it's moved up again. Every time you see a report from me, gold goes up. It's currently worth about 1960. It's currently trading at, where's gold? Gold at 1931, so it's undervalued. People buy and sell gold for different reasons. As a commodity, 1760. As a currency, 1965. As an inflation metal, 1915, but that may go up. But the big thing is, as a crisis metal, it's very undervalued. And of course, silver belongs 25, 26. So under here, it's extremely undervalued. But markets can stay overvalued or undervalued for a long time. The difference is, number one now, in terms of gold, because you've heard all the other stuff, central banks are buying at the record levels. And again, we don't know what's going to happen on the 22nd in August with the BRICS meeting in South Africa. Secondly, when there's a stable gold coin, and the World Gold Council has talked about it, gold will certainly soar. And again, if there's an international gold-backed currency, probably not here, gold can really go up. So when will precious metals be widely liked? And I think of 6 reasons that can happen between now and May 2024. And basically, we're buyers and have been buyers for gold and silver for May 2024. As traders, we wait for it to go down and then buy it, but as investors, we're just holding it. First, there's generally positive astro, so more or less gold and silver are going to do well. The second is if and when gold becomes a floor at 2,000 and then we don't know how high it goes, 22, 24, 25 or higher, that's going to bring a lot of new investors in. The US dollar being damaged, which can happen in a number of ways, including BRIC competition, a gold stable coin. The most obvious one is a geopolitical crisis, whether with China, whether to Ukraine, whether elsewhere, can bring in gold to jump to 2,200. And then a zeitgeist shift. At some point, algos are going to change their views, and inflation is not bad for gold prices, but good for it. Now, it's not as good for gold miners because their costs go up, but if the commodity goes up, it's good for them. So there's a lot of possibilities, but that zeitgeist shift may very well happen between now and May. And basically, we're long between now and May 24. So we're going to start with one company of ours. It's one of two that we gave in the beginning, and I want everyone to just review it. It's going to be short. We just asked for 5 or 6 minutes or so. 4 reasons why we like Mag Silver. It's one of our favorite companies. We have them, and I believe for fundamental and sector reasons, this company is going to do extremely well. So I'm going to mute myself in a moment, and then we're going to watch this. It's a short thing. Then I'm going to come back, talk more. We have 2, 3 other short sponsors for about 5, 6 minutes, and then we're going to take Q&A. So we have a lot more material to come, and I hope you're going to find this valuable. So let me put this up, and I'm going to mute myself now and put the thing. So.
Hello everybody, welcome to Mag Silver. For those of you who know us, I hope this is a timely refreshment. For new people, hopefully this is an exciting introduction to Mag for you. Mag Silver, we essentially have 4 assets. The one, the Scipio property, which we joint venture with Fresnillo PLC, who are the operators in the state of Zacatecas in Mexico. The Deer Trail property in Utah, which is a porphyry carbonate replacement type prospective exploration play for us. And the Larder Gold project in Ontario, sitting on the Cadillac Larder break, like Deer Trail, like One Scipio, very prospective locations for mineral exploration. And the 4th asset is our people. We've got a very broad, experienced group of management, board of directors, with a lot of experience in the mining business. And so bring it all together, I think MAG creates a great opportunity for investors. So discussing the Juanicipio property initially, this is a property that we IPO'd the company on in 2003. We had an exploration theory there, which was a little disruptive to the general geological thinking in this Fresnillo trend within Mexico, the preeminent silver district in the world. We came in on this property and we discovered the Juanicipio vein on the first hole we drilled. That's a real fairy tale story in terms of exploration. We then discovered on hole 16 the Valdecanes vein, which is about a kilometre to the northeast of where the Juanicipio vein, the initial discovery, was. And well, the rest is history. Valdecanes represents a fluid upwelling zone, the source of mineral for a considerable amount of, again, one of the most endowed, probably the most prolific silver district in the world. And the exploration success that we've had at Valdecanes has been immense, and we've scratched the surface. We've drilled 5% of the footprint of the joint venture ground, and we've found arguably one of the best silver deposits in the world. A project now that we've constructed, we started commissioning and ramping up Juanicipio in the first quarter of this year, and we've now got a good head of steam up. We announced commercial production on the 5th of June this year, 2023. You can see our quarter 2 release of production. We're into the consistent high grade now, 498 grams per tonne for the quarter. We made almost 5 million ounces of silver in the quarter, and that's going to create an incredible platform for us to grow MAG Silver. As we continue through the year, we intend to ramp up that production profile from about 85% nameplate of the 4,000 tonnes to the 4,000 tonnes per day, and we continue to see good grades coming through. So we're looking at a very significant silver production supplemented by gold. We made almost 10,000 ounces of gold in the second quarter, lead and zinc, and then as we get a little deeper into the mineralisation, copper comes in. So a wonderful tier 1 cornerstone asset that's just coming online now, and a startup that's been quite successful. We intend to sort of get cash from there. It's going to enable us to execute on our other 2 exploration properties we have. The first one is Deer Trail in Utah, where we're drilling our phase 3 drilling now. We've had quite a lot of success drilling this property in terms of defining the spokes on a hub and spoke model, which is somewhat analogous to the Bingham Canyon property. I think most people who know anything about mining know Bingham Canyon, one of the best porphyry coppers in the world. But 80 years ago, Bingham was mining spokes of high-grade silver mantos, and that's what we're looking for here. What's unique about Deer Trail is the size of the system. Every hole we've drilled, we've hit mineralisation, and the fact that probably for the first time in a century, we are the one group who has consolidated all the land, and we can now approach this from a regional scale. So watch Deer Trail. That's going to be quite an exciting part of the next stage of MAG's growth. In Ontario, we recently, a bit over a year and a quarter ago now, we acquired the Larder deposit. This is a potential gold deposit, exploration play sitting on a very prolific structure in the Abitibi in in northern Canada. The history of exploration success and gold production here has been quite immense, and we're putting the first deep holes into this property. And so, again, with Larder, we're expecting to have success here as we move forward. We've fully funded the exploration at Larder through flow-through financing that we conducted in January of 2023. We've fully funded that project to the end of 2024. And then we go back to Juanicipio. Is that plant starting up, looking good now, getting into credible production, very good grade, exactly where we expected it to be. Recoveries consistently now above 88% for silver. Every batch of concentrate we made saleable. Big focus on that coming online, generating cash coming back to Canada, and then what do you do with the cash and that sort of stuff. I go back to the fact that what we found in Juanicipio is remarkable, but we've got 95% of the property to explore. And we have a very compelling case now that there are potentially 2 more of these fluid upwelling zones on the property. So Mexican regulators, permitting, gods helping us, we hope to be able to be drilling these properties in the near term. And obviously success at Juanicipio is just going to be an incredible value driver for MAG. So now's a good time for MAG, where Juanicipio's hitting its straps. We have robust drill programs at Deer Trail and Larder, and as soon as we get the permits to get into these other potential upwelling zones at Juanicipio, I think that's going to provide a lot of excitement. In the interim, we're doing step out and infill drilling around Valdecanes, and we're adding a lot of value every year. Every structure we hit around this system is mineralised. There's an adage in the business, there's no better place to find minerals than within the shadow of a head frame. There is. Find minerals where you're currently mining, and that's what Juanicipio represents. So that's MAG Silver, the website, www.magsilver.com. If there's any questions, get a hold of us. We like talking about it. All the best to everybody and good luck. Bye.
Okay, we're coming back, and let's continue a little more. At the moment, just for reference, MAG Silver is about $11. We started buying it actually around 15. Did most under a little bit at 13, because to me under 13 is a steal. Some bought at 10.50, some bought at 10.92, but to me it's far, far more valuable than this. I just suggest you track it, and if appropriate for you, buy it. Okay, let's continue now. Where do we buy? What's been most successful, of course, is buying commodities. Every time there's some, quote, bad news for commodities, it goes down, and then fundamental players come in. So on gold at the moment, while it's been holding 1925, and if you want to take a positional trade, we're not talking about a daily trade, anything between, if we get lower, between 1915 and 1880 is a joke, because obviously we think it's worth 1960, so as investors we don't mind adding to it. When it comes to silver, 22 is an important support level. We came in at 18 and elsewhere went as high as 26, which is why if you're in commodities you may want to trade it out. But we think it's worth 25 to 26, so clearly anything here is a buy. Given the fact that markets, our view, are going to go lower, so you don't want to use up all your power. Now, copper is interesting because long-term copper is really good, but if we're in a recession, it's not so good. So basically, we got out at around 425 to 450 in that area, but anything here around 340, 350, 360, let's take a quick look where we are. Copper at the moment is around 366, is fine. So basically, again, a very slow amount. Copper is going to go back, in my opinion, to the well above $4, but it can stay down for multi-months. So you have to be very selective and accumulate on weakness, because again, it's going to be hit. Oil is the most interesting. We made so many trades there that were successful. We think we're not going to be totally out of the game until 192. Fundamentally, is bullish for gold with the exception of oil, with the exception of China, which is bearish. So that's going to be a dynamic. Clearly, 80 to 88 is where it's worth. Under 82, which I think we are at the moment, it's potential to buy. But once you get to 84, 88, or 92, while we could go higher, we're out. In the same way that bonds, when we got to 420 and 425, we're out. That doesn't mean they're not going to 450, but when you're buying at 325 and 350, you've gotten the bulk of the trade. So at the moment, we're watching oil. It's probably good to be on the long side, but it can go a lot lower. So you need protection in falling or recession markets. Interesting forecast. As you know, in 2000, we said the world was coming more global. As of 2020, deglobalized, decentralized, and of course, robotics and AI, which are very hot at the moment. We've talked about this in detail before. Excuse me. This is some of the astrology stuff. Now, the big astrology issues are the Pluto return, which means in the U.S. horoscope, it's going to be rock and roll, certainly until the election of 2024 and maybe a little bit beyond that. So we're definitely in some very serious challenges. The Indian yoga transit, which we'll talk about, also suggests a hit to the market, similar to what we should have had when we had the financial crisis. And Biden himself, both physically and elsewise, it has a much more difficult 2023 ahead. It's just beginning. So, the first eclipse, and by the way, we can see these before and afterwards, was the financial crisis. We have another one potentially coming, although it's not generally as negative, only because we didn't have it. And we're somewhat bullish with the eclipse coming in the spring, summer of 2024. So we're going to be shifting, hopefully from much, much lower numbers to becoming bulls next year, probably started with the Fed lowering interest rates. But until then, we're by and large bears. So we still think the market's well overvalued. We think we can come down. The risk reward favors the bears. But as of next year, we'll be going the other way mostly. Obviously, FOMC meetings are important. Right now, it looks like they'll hold September, but that can change because inflation is 5%, actually 5 to 8, depending on where you're looking. October is mixed bag. And I tend to agree with Goldman Sachs at the moment. That's what it's looking for. Now, this particular yoga thing, which is, I'm not primarily a Hindu astrologer, but we did see these things with the terrorist attacks. We did see this in 1929. So we would not be surprised to see markets still go to the October lows of 2022, but we certainly should be below 4,000 on a fundamental basis. Now again, markets can go up for lots of reasons, but they're not substantial there. We talked before about India being more important. The market's at record highs for obvious reasons. The Chinese market, which is in trouble, actually is going to be better in 2024, but I think it's got more pain ahead. But the interesting new focus, which is coming in now, is Canada. Much easier trade than India, than China, and between now and 2025, Canada will be preferred, and there are a lot of good Canadian companies, not only in mining, but in other areas as well. So you should look at Canada a bit more, and obviously the currency will do better as well. In Chinese astrology, we have the year of the water rabbit, trading markets. And this is a trading market for sure. And I don't think that's going to change. So, by and large, though, most of these trading markets have been very positive. So we may end up positive as well, but at the moment, we're certainly into October staying on the bear camp whenever possible. Valuation, copper is somewhat properly valued. Obviously, if I can buy, I don't know if I will, at 340 or 325, I will do so. U.S. bonds are in the right range. While we could go to 450, we're out of that game because we've gotten the meat of that trade. And oil is properly priced. If it goes below, we may do it again. If it gets above by 92, we're probably exiting the same way we are with bonds. Doesn't mean we can't go to 100. It just means that the risk reward is not as good. What's improper is gold, since it belongs at 260 at the moment. Gold, silver belongs at 25, and that's a big disconnect. We think the S&P is well overvalued, whether it be the 200-day moving average or whether it be the sell in May numbers. I think we'll get to see. NASDAQ is just a joke, but we did have a lot of bullish astrology for it. It actually continues a little longer, but I think we've gotten most of that trade, and Bitcoin obviously overvalued, although there's been good news for it recently. So what are the 8 fund strategies? Inflation protection. You know this already. We don't have to repeat ourselves. The traditional ones, which we've talked about, wine, fine art, farmland, luxury, and real estate. Real estate, obviously, depending on location. And we always like to say that as a wine writer, and if you go to afund.com/wine, you can see our view on wine. And I like the traditional view that they had in England in the 1920s. You buy 2 bottles. When the price doubles, you sell one and drink the other. That's the way to play the game. And of course, art, if you want to do it, buy it because you love it, not because it makes you rich. Of course, if you're smart, you can make you rich too. The ones that we talked about before that were given by Kramer, we only played 4 of these. Fossil fuels, obviously good. Healthcare, very interesting. Defense, obviously good, although we're starting to downgrade that slowly. Food and beverage, obviously. We were wrong about travel. We thought that travel would not be as strong as it is. However, we didn't lose any money because we don't play it. We don't mind being wrong and not playing something that makes money. We just don't like to play something that loses money. So we were wrong about travel. It's a lot stronger than we expected. But all these areas were good inflation hedges. I don't know if they're going to be going forward. Distressed investing, just beginning. Deep value, M&A, just beginning. Private equity, hedge funds, commodities, real estate. Day trading until markets are below 4,000, we'll almost always be trading the short side. Even on the days when they're up, we'll just wait for them to go up and then we'll go down. There are other ways to play it, just the way we're playing it. And the sectors are the same that we had before. Usual stuff. Obviously, there's a bifurcated market. Regardless, long and short is the best way to trade. Obviously, there have been some really bad stocks, and bad meaning like, say, Disney, which is shooting itself in the foot now and will continue to do so. Bud Light, again, regardless of what your political views are, you don't destroy your your base and tell them to get lost. Very dumb. Things like hydrogen are very interesting, the way that lithium was before, although lithium's still pretty rich, obviously, but that's playing the future. And that 5%, I mean, a lot of people are paying, a lot of areas are 8%, but I think 5 is certainly going to be where we'll be in the next 2-3 months. So well above the 2% of the Fed, so which I would advise them to do one more, even though they'll get yelled at. Safe investments, some REITs, some Dow Dogs, etc. Again, that's for 2024. Our viewpoint is invest for 2024. I think an interesting area, recession one, is camping. And not only are you saving on hotel bills, but things like Camping World Holdings, Thor Industries have done well. I think they'll continue to do well. So there's a bunch of areas there. But especially the camping area was a very successful one, and I think it's a recession-proof one going forward. And be cat-like, wait. If energy goes way down again, we'll play it. Silver, certainly a 22 is good, 18 even better. And the most important question, whether you take any of my advice or not, is to be prepared if and when a crash happens, to be able to buy truly undervalued quality stocks and assets. If you're able to do it, then I don't care if you follow any other advice. But make sure you have the capability, because if the markets go way down as they did before, and you've got to be able to buy. If you're heavily leveraged and they're down, and you're heavily leveraged on the long side, you may have problems. So make sure you have the capability and the patience for when markets come down. We've talked about it. Again, you want to look at companies that can survive and prosper in a recessionary environment, unless you believe the fantasy that we're having a soft landing. I don't believe it. We'll see. I don't believe the statistics. They're not as bad as they were in Argentina, which, by the way, just has now, I think, 115% inflation. They just devalued their stock again. But you want to be able to survive and prosper, even if people ignore it. So the idea is to be selective. I think this is trader's paradise, no question. You can make money on the long or short side. So investors have a long-term horizon, invest for 2024, and traders a very, very short one. So we have maximum allocation to precious metals and base metals. We haven't changed it, rotated a little bit. Same thing. This is just a repeat again. Gold valuation. Remember, when gold goes up, these many gold stocks and silver stocks will do extremely well. You should have some in your portfolio. Obviously not everything, but some. We present periodically lots of these companies. We're in positive gold seasonality. There's positive Astro. But remember, every time there's inflation, the computers sell it, and then as a trade, you buy it. So it's a seesaw situation. Our gold investment picks, the big ones, of course, Agnico Eagle, DRD Gold, Franco-Nevada, and Wheaton. We have others, again, depending on how much you like. And we're constantly watching lots of stocks because it's an area, being a Leo, that I like. Silver, we have Max Silver and Heckler, which are our favorite one. Lots of things. This is nothing new here because by and large, our powder is dry for most of these things. Now, there's a famous Russian saying, although we're not supposed to quote Russian proverbs, which is done by the race car drivers. He who does not take a risk does not drink champagne. So we treat microcaps, which we're going to give you two that I think are worth looking at, as non-expiring or long-dated options. Non-expiring or long-dated options. And there are two presentations we want to make in this area. One is the metals company, which you've heard before, went from 60 cents to $3 to $1 to $2. I mean, it's very tradable, but we believe over the next 2 years it will be in the $3 to $5 range, so you can just buy it or trade it as you like. And there's a new one, Jaguar Health, which we're going to be presenting to you because biotechs, which are down 90%, when you get a positive outcome, go up 3, 5, 10 times. And this is one of the ones we think that's on our list. So we're going to start with the metals company and give you a presentation in Jaguar, a little bit more talk, one more company presentation short, and then we go into Q&A. So let's get to the metals company. Let's see. I think I've got it here. Give me a moment, and then we're always a little slow on this. Let's see, Traders Workshop. Is it here? No. That's there. Let's take a look. Give me a moment. And I'm going to go quiet for a moment, so we'll be bringing it up very shortly. Okay. That's there. Market's down nicely, as you can see, and it's going to continue down. We chose this for a reason. Okay. Let's Let's go find where is our... Let's bring this up.
Good morning. I'm Craig Shesky, Chief Financial Officer of the Metals Company, listed on the NASDAQ with the ticker TMC. At the Metals Company, we are developing the world's largest estimated undeveloped source of battery metals. It is a resource in the form of polymetallic nodules, and this is what 3,000 tons of these polymetallic nodules look like after a successful pilot mining in late 2022. Now, this is a very different resource. These nodules sit unattached on top of the seafloor in this area of the Pacific known as the Clarion-Clipperton Zone. And they form by precipitating the metal in the seawater, and that includes nickel, copper, cobalt, and manganese, all critical minerals on the U.S. Geological Survey list. There's very high grades of these metals, but importantly, it's not just what is in the nodules, but what's not down there. There's no plant life, which means there's limited animal life. The nodules are not buried. They sit on top of the seafloor. So to collect them is more like picking up golf balls on a driving range than it is typical mining. And I'll show you what that looks like a little bit later. But there's no digging, there's no blasting, and there's no drilling. In fact, back in the 1970s, you had thousands of tons of nodules collected by certain companies like BP, Shell, Sumitomo, Mitsubishi, Lockheed Martin. But there wasn't yet any regulatory environment on who owned the ocean. So that's what's different today. The technology to do this has been here for a very long time. However, we now are in the 11th hour of getting that final piece of the regulatory puzzle with a timeline now that would allow TMC to be the first commercial collector of these polymetallic nodules. And we intend on applying for that commercial application after the July session next year of the regulator, which puts us on track to be in commercial production by the fourth quarter of 2025. Now, this is the largest undeveloped nickel resource on the planet. In fact, it's the #1 and #2 largest nickel projects on the planet, according to mining.com. We were ranked that by mining.com for 2 years in a row. In fact, we are really the only major scalable alternative to Russian and Chinese controlled supply. So that's important for a national security perspective as well. We have a sufficient amount of nickel, copper, cobalt, and manganese to electrify the entire U.S. vehicle fleet, or roughly 280 million EVs. So it's an order of magnitude higher than the typical undeveloped nickel projects. And in fact, our first vessel alone could do in excess of $1 billion in revenue per year. So this is a vessel that we already have exclusively for TMC use, and you're effectively taking converted drill ships that may have less to do in the coming decades for offshore oil and gas exploration and devoting it to nodule collection. So we can ramp up in a very CapEx-light manner, and then we can send these nodules to places on shore where the infrastructure already exists. So unlike on land where you get a permit and then you have to spend billions of capital and several years of ramp up, here you could be in production within a couple of months after getting the permit. And what makes this unique, what means the economics per ton are much better than land-based sources, is because this is a very high-grade resource. In fact, some nickel projects have a very high grade but a low resource. Some have a high resource but a low grade. We are a total outlier in that we have the highest nickel equivalent grade of undeveloped nickel projects and the largest resource. So projects like this tend to get developed. Now, in order to figure out that resource, we actually have quite a bit of data, including surveying the seafloor. So because these nodules aren't buried, it's a two-dimensional resource. It's actually quite easy to determine how much you have, and you see some of those images here. In addition to sampling through box cores, where you can weigh and assay the nodules. And they have a very consistent mix of these metals. And what we have here is actually 2 of our contract areas, each of which would independently be the largest nickel project in the world. Combined, they have 1.6 billion tons of these nodules, something that might be worth $500 a ton of revenue. So this is a major opportunity. And you'll see, too, it's a very consistent grade from one contract area to the next. Now, we are the only contractor that actually has both Canadian and SEC-compliant resource statements. So this is an investable situation, and our pre-feasibility work is now being done by Bechtel, and that'll be coming out before we apply to begin work. Now I'll just show you a little bit of the technology here. This was our pilot collection test. We're the first ones to collect these nodules since the 1970s, collected 3,000 tons. So we've effectively de-risked the offshore technology. And this is what it looks like when we first got nodules up. You'll see it's a drill ship. There's a collector vehicle. Again, it's more like vacuuming up these nodules as opposed to actually mining. They're only disturbing the top few inches of sediment. So you launch off the side of this vessel, and then I'm going to hop ahead here very quickly to what this looked like when these nodules first came onshore. To the vessel.
Yep, nodules.
So they go up a riser pipe, 4,500 meters, and we produce 86 tons per hour of these nodules. We're going to be ramping that up because we'll add a second collector vehicle as well as a wider riser pipe to allow for more throughput. So that's what the nodules look like on board. This is 3,000 tons of those nodules in the hold of the vessel. But importantly, this is, not something that only TMC is doing. Other people are observing it, and there's a shift in tide where you're getting a lot more media attention, noting that this is a question of when, rather than if nodule collection will occur, and a full-throated endorsement from The Economist in July. China is also investing a lot in deep-sea mining technology, as is Norway and Japan, who announced that they're going to be producing resources from the deep sea in their territorial waters, and even Transocean devoted a drill ship to the Belgian contractor. So this is no longer in the realm of theoretical. This is happening. And that actually drew out the United States. That doesn't have their own contract area, but this is a matter of national defense, given how far behind the U.S. is in securing critical battery metals. And in fact, the Department of Defense has now been called upon by Congress to deliver a plan on how the U.S. can get involved in nodules. And frankly, it would only be through companies like TMC. But it is quite valuable. Our first project alone, which is just 22% of our resource, in which we've already spent over $400 million, has a net present value today in excess of $10 billion. Again, that's just 22% of our resource, and yet we're only trading at 3% of that fundamental value. Whereas if you're a nickel developer on land, you might trade at 30, 40, 50% of NPV at this stage of production. So there's a massive opportunity, and I'm delighted to be able to tell you about it. If you have any questions, please feel free to reach out to me, craig@metals.co. Thank you very much for your time, and hope you enjoy the rest of the conference.
I think you can see it made a very compelling case for the metals company. I want to point out, though, it's very much in play among traders. If you look at the chart, it goes up and down, so you can trade it if you wish, and I would only do it on the long side personally. But you can also just buy and hold it, I think, for 2024, 2025 potentially as well. You can certainly hold it for those 2 years for, I think, what will be $3 to $5 targets. Okay, next I'm going to give you Jaguar Health. This is a company we just were introduced to. We haven't finished our due diligence, but we like it for two reasons. One, we like very much that it's down very heavily, which the president's not happy about, but like all biotechs, they're way down. But biotechs that have a good story, and I don't mean story, excuse me, of course they have a good story, but they have a good result, can jump 3, 5, 10 times, and this is one of them. They have 2 this year, and possibly 1 additional one next year. So I like the fact there's more than one shot at the brass ring. I definitely think you want to track it. Whether you buy it or not depends on what your portfolio is, but it's certainly a company worth doing some due diligence on. So give me a moment and I'll bring it up. Right. No.
Hi, my name is Lisa Conti. I'm the founder, president, and CEO of Jaguar Health, and I'll look forward to introducing you to the company and this opportunity. First, let's dispense with any forward-looking statement. We are a public company traded on NASDAQ under JEGX. What Jaguar does is all drug discovery from plants used traditionally in tropical areas. Our medicines are all plant-based. We did take a product from a tree growing in the rainforest to a first-in-class paradigm-shifting agent, anti-secretory agent, called Mytesi. The generic name is crofelemer. It is plant-based, it's organic, it's fair trade, it's sustainably harvested, and it is the only drug approved by the FDA under botanical guidance. And under botanical guidance, there is no practical pathway by which to bring a generic to market. So even though we have 150 or so patents issued and file new ones every day, we essentially have exclusivity forever. What's really valuable about crofelemer is that it is a pipeline within a product. It's approved initially for the current indication of HIV-related diarrhea. That's a specialty market. Another word for specialty is a relatively small market. It has about 8 different follow-on indications. We can't do everything. And the 2 most important follow-on indications that we're pursuing at this moment are for chemotherapy-induced overactive bowel or cancer therapy-related diarrhea, urgency, unpredictability, incontinence, preventative treatment for patients on targeted therapy, which are the new therapies that patients are typically on for months or years for the rest of their life, and the rare disease orphan indication of short bowel syndrome with intestinal failure and a pediatric intestinal failure condition, ultra rare, called microvillus inclusion disease. The most important thing that I can tell you in these 5 minutes is in these horrible market conditions for small cap companies right now in 2023, we have literally around the corner in the next 4 months 2 major, what we feel will be transformative, value enhancing opportunities for the company with late stage clinical activities that have the potential to turn into major revenue drivers in 2024, and most important, major benefit to the neglected comorbidities and neglected healthcare needs of patients. Those 2 events are, first, we have completed enrollment in a phase 3 final pivotal trial for chemo and therapy-induced overactive bowel, which includes symptoms such as chronic debilitating diarrhea, loose watery stools, urgency, incontinence, as I mentioned. This is a prophylactic study. That means preventative treatment, a basket trial for patients with all solid tumors on targeted therapies. Targeted therapies are the tyrosine kinase inhibitors, epidermal growth factor antibodies that you see advertised direct to consumer, often on television. These are agents patients are on in both a curative and a metastatic situation for months, years, and often for the rest of their life to keep their cancer as a chronic condition that can be managed. Top-line data, the last week in October. This is for Mytesi, the product that is already on the market, and so then it is the natural regulatory steps to expand the indication to address the cancer indication beyond the current approved indication of HIV. The second major event is a proof of concept study for the rare disease indication of short bowel syndrome with intestinal failure and the ultra-rare indication of MVID. With published proof of concept data with 6 different investigator-initiated efforts that we have going on in 3 different continents, the first data will be coming in the 4th quarter of 2023 and then throughout 2024. And in Europe, under the regulatory agency there, the EMA, there's an opportunity for reimbursed early patient access program to get these products to patients with high morbidity, mortality, expense, active patients group, while the patients are going through, while the product is going through the rest of the development program. So these are the 2 major events. It's the takeaway message from anything that you hear or learn about Jaguar. There's much more to be learned. And here are our websites for Jaguar.Health and Napo Pharmaceuticals, which is a family company which has specific information about crofelemer and the products I just talked about. Thank you, and look forward to seeing you on our websites.
Okay, everyone, we have some good reasons to take a look at that. We have some more things to cover, one more presentation, and then Q&A. So, obviously, battery metals are positive, and of course, we like the metals company. And again, these are the same that we gave in the beginning of the year. Aggressive ones, if you're interested, two other aggressive healthcare picks is Biorestorative Therapies and Can-Fite, both of which are for us 2024 plays. But Jaguar, as I said, we're doing our due diligence, but I think it merits serious attention and probably a few nickels. Energy clearly did extremely well. I mean, it's just bananas what's going on in that space, but it's very tradable at this point, especially with the China situation, which will improve next year. But we're at numbers that we're mostly comfortable. We're now below 80, so we may buy again, but we like to pay. That's only the first P1 position. We like second or third, because that way, if we're wrong, we lose very little, and we'll probably make more. So there's a lot there. Clean energy and green energy obviously are going to do well with the Inflation Reduction Act, but a lot of that's next year, not this year. Distressed investing, a good place to be. Office REITs, for example, New York City, not anything we're doing, but we're looking at. Biotechs, we gave one here. Regional banks were obviously good plays, not our specialty, but that was a good play. We didn't do it, but we saw it, and we know people that played it. Defensive ones, there are companies, if you must be invested, things like Acme United, Global Self-Storage, Penske, and Industrial, even Verizon, although we'd like it a little bit lower. These are things we're going to look at as soon as the market's certainly at 4,000 or below. And of course, entertainment. We have one that's coming out next week that we'll be talking about. We're personally heavily involved, but disclaimer, disclaimer, disclaimer. And agriculture, security and defense, of course, has been massively good. If you want to play that game, we'll probably do more security than defense, because we'd certainly like to see the war over, although that's not our bet. And there are always special situations, and we're going to give one now. The special situation is in the diamond area. As you know, BRICS are very increasingly every day, BRICS, BRICS, BRICS. Brazil, Russia, India, China, and South Africa. Well, traditionally, we've had one South African play that we've looked at, and that, of course, is DRD Gold, because it's very SRI. There's no exploration risk, and it's just a good company to play the gold sector. But given there's so much emphasis on South Africa, and again, like Argentina, you want to wait when things are very bad, we saw one that we're just studying now. We haven't finished our due diligence of, but it's an interesting play in diamonds, which some of you may like. So let's put that up. Shut down the sound here. Oh, shoot. One moment. Okay.
Hello, I'm Dean Taylor, the CEO of Diamcor Mining, Inc. We are a production-focused diamond mining company with a proven history of supplying diamonds to some of the best players in the world. Today I'll give you a little overview on our presentation. You can learn a little bit about our company. Before we get going, obviously we'll look at our forward-looking statements.
Well, we seem to have some audio visual here. I will reload it. Give us a moment, please.
Hello, I'm Dean Taylor, the CEO of Diamcor Mining, Inc. We are a production-focused diamond mining company with a proven history of supplying diamonds to some of the best players in the world. Today I'll give you a little overview on our presentation. You can learn a little bit about our company. Before we get going, obviously we'll look at our forward-looking statements. We're going to make a few today, so do note that. Company highlights-wise, as I've said, we're focused on the acquisition and development of mid-tier production-capable assets with have gem-quality diamonds. That's usually our focus. We do have a strategic alliance with Tiffany & Company. Tiffany is the shareholders. So far from the trial mining exercises getting this project ready to go, we've generated about $38 million in U.S. revenues, and we've reinvested that largely into the project. We've probably, between the money we've raised and what we've reinvested, about $100 million into the development of getting this going. Last year was a great year for us. We did about $7.2 million in revenues, again, just off trial mining. We had a bit of an issue with Eskom power supply at the end of the year. Otherwise, we expect we would have been profitable even during the trial mining. And we averaged about $340 US per carat, which is quite a bit higher than the worldwide average due to the gem quality we have. This project is a one-of-a-kind opportunity. What it is De Beers had identified approximately 50 million tons of the main pipe of Venetia had been displaced and created a fan deposit. We acquired that, and that is the nature of this project. Very, very simple, very low-cost operation. As I said, we had problems last year with the power system in South Africa, and as of July of this year, we had announced that we had corrected that by some recommissioning of our existing gensets to ensure that we have independence from the power supply. Now, we do have a strategic alliance with Tiffany's. Tiffany's provided us about $10 million in financing in exchange for a first right of refusal. Their interest is really in the supply of non-conflict diamonds of high quality over the long term. They do get a first right. It's not an offtake agreement. Essentially, they can pick what they want from our production and pay fair market value for that. So it's really about getting non-conflict diamonds into the system as we go forward. Now, when we look at the project itself and wonder why is this opportunity significant, first of all, you have to understand that it is directly related to De Beers' flagship Venetia. Venetia is about a $4.5 billion mine. It is one of the most prolific and largest diamond mines in the world. It has gone underground as of this year. At its peak from the open pit, it was doing about 750,000 carats a month, or about 9 million carats per year. Now, a large percentage of those, about 60%, we would estimate, is gem quality, the same as ours. And they do get large stones. Venetia to date is up to 315 carats in individual stones they've recovered. And we do expect from our project we'll see some stones up to that side potentially as well. Now, De Beers had identified early on that approximately 1,000 meters of the top of the Venetia pipe was pushed off in a glacial event and then subsequent erosion. It's not an alluvial. This is a fan deposit. About 50 million tons of that pipe was displaced, and therefore we know that the pipe is about 100 carats per 100 ton, about 50 million carats. Now, we're never going to find that, but somewhere, we would target somewhere between 5 and 10 million carats would be what we're searching for. We acquired just under 6,000 hectares directly adjacent to the pipe, and that's what we work. Surface mining, no underground, and we recover the material and the diamond. Now, it's a late-stage opportunity. You can see here from our numbers last year that everything is trending certainly in the right direction. Our losses, like I say, were minimal last year, even with the trial mining exercises that were going on. We did definitely put in the independent power systems in July. This really just gives us the ability to be independent of the South African power system if need be. Further expansion, right now we're doing some drilling bulk sampling. We'll be expanding into the greater areas. That gives this project a tremendous amount of growth. So right now it's all about defining those outer areas a little bit more and ramping up things as we go forward. We'll do different modular things with the plant, but it's able to be expanded quite easily and ramped up. Now, the growth opportunity, as I've said, we initially have a 30-year mining right over about 650 hectares. We've got 5,800, so we will certainly be going towards those outer areas as we are now. That work started about 2 months ago, and we're making progress very quickly on that. That'll generate a new 43-101 and a final mine plan that we'll move to in these outside areas. So the key takeaways when we look at everything for our company, we are very much a late-stage quality project. We're co-located with one of the biggest and best mines in the world. It obviously has considerable benefits. About 85% of our property is yet to be defined. That will take place. We do have the strategic alliance with Tiffany's. Extensive infrastructure, like I say, roads, water, power, everything that you could possibly need, all in place. Certainly the supply-demand opportunity, right now. We do have a high percentage of gem quality. We certainly know many of the bigger diamond mines are reaching the end of their lives, and production is expected to go down worldwide. And also the Russia-Ukraine conflict, keeping in mind that Russia supplies about 30% of the world's diamonds, and obviously those are significantly affected in terms of the sanctions. So shortages are very real going forward. We will see increased processing volumes now as we go forward, as we move into the outer areas. More processing equals more diamonds, more revenue for us. And we've certainly shown the potential for profitability. We know we break even on very low carats. As we go forward, we're already cash flowing, and we expect to increase that year over year going forward. So that's a bit of a presentation on our company. Thank you very much for taking the time. And should you have any questions, please feel free to contact me at any time. Thank you.
Okay, we're getting close to the end now. Then we're at, obviously, AI is big, and we have actually one coming out. We can't talk about it yet because it's going public next week. That could be one of those exciting companies. But it's an area of AI, robotics, space technology, most of which, of course, is way ahead of itself. But that doesn't mean that you can't make a lot of money. But remember, in the earlier stages, to take some profits. So our final thoughts: invest for 2024. There are great physical and economic challenges. By no means have they been dealt with. Caution is extremely important. Have the ability to buy if and when the markets panic, and have a selection of what you want to buy. And that's usually, the pricing is usually the 52-week lows or the October lows. And winners and losers, good stock picking will greatly outperform index funds. Invest for 2024. So basically, our goal is to make more money with less risk. Hopefully, we've given you a few ideas. I will take questions and answers in a moment. For trading, we personally like to do astrology and technicals. Very often, we're there first. It's dangerous, but in options, it makes sense. And investing, we always want to look at fundamentals and go in the direction of that. Our next webinar is planned for December 21st. Hopefully, we'll have lots of success stories, and at least for part of the year, be on the bull camp rather than on the bear camp. So let's take a look at what we've got here. And oh, let's see, no questions? We're certainly willing to. Let's take a look at this. How did my chat get in here? That's interesting. I'm going to give it a moment. If people have questions, please put it in the chat room. If it's not, hopefully everybody was so excited they didn't need anything additional. Let's see. I'm going to put things in Q&A mode. If anyone, I guess nobody put anything earlier, but if you have some questions, we'll take them. Wow. I hope I've, and there's no questions. It's either great or it's terrible. I'm going to hope it's great. But again, most of what you've heard before, especially if you follow us on YouTube and if you follow us on Telegram. Good question. First one, how do we see the October 22 lows coming? Well, if there's some reality in the marketplace. I mean, there's a lot of possibilities. If it's going to come, it's going to come quick. Clearly, the market, if it goes down, will retest first the 4,200 to 4169 level in the S&Ps. And then it will have to break the 200-day moving average before the big guys become bearish. There are lots of things that can do it. Obviously, any of the big seven that mess up badly will make people worry because they're, 400, 500 times PEs is ridiculous. So you're doing it in fantasy land. So all you need is one of the big eight to go wrong. You need a problem in the Ukraine. I don't even want to talk what that could be. More serious things in China, more serious things with our president. And there's just so many, there's always lots of things that can happen, but there is the astrological background that it can happen. But for it to do it, we'd probably have to be under 4,000 and probably under the 200-day moving average, in which case it could come very, very quickly. Is there more material from the last two presentations? No, I mean, basically our last two presentations are there. We try to give it periodically on some of our YouTube things, but the main thing is we're mostly bearish. We like commodities. We like to buy them on upside, and then we like special situations. And the special situations we basically hold because they have good fundamentals, and we don't care what the market does in between. So those are good questions. I don't know if there's anything additional to say because, to have more than 20, 25 stocks is just sort of a little ridiculous. You play a few, and we're going to give in December a group of five, two groups of five that are very high risk, medium risk. We're going to put a few portfolios together that people can look at, or perhaps sooner if the markets go way down. Until then, it's la-la land. If we take a look at the market before I close off, we'll see it's only down, let's see. It's only down a little bit, but obviously 4,400 is important. Once we're under that, we can go. And of course, NASDAQ can drop 20% tomorrow. Right now, people are still buying NVIDIA, but it's a joke. Really, it doesn't, why they think it's worth 400 to 500 times PE is beyond me. But you eventually do run out of suckers. Yes, I'm going to be posting today's presentation, of course, on the YouTube channel. We're not going to edit the few little things in there. Probably will be up in 2 days. We'll try to have it up by Friday, if not potentially tomorrow. So thank you very much for everyone for attending. I'm going to be closing it off. I hope you like it. And again, be cautious. Don't buy the idea that there's going to be a soft landing, because there isn't, but there'll be lots of people believing it, and therefore they'll be buying the market, and that's the time we'll be selling it. So hope you all appreciate it, and everyone have a great day.